Good morning, everyone. We are recording this, so we'll be sending it out later on. It'll also be posted on our YouTube channel. Feel welcome to ask questions in the Q&A section today. We'll happily answer questions as we go along. I think we're going to definitely have today be a lot more conversational than our prior webinars. If you've been on some of our prior webinars, um, Travis couldn't resist. He told us last night he wasn't going to come, and here we are. We're
Can we
happy
can
to
we
have you, though.
can we test the chat? Could we go
Yeah.
ahead and test the chat to see if people can hear us? So
Oh,
if
yeah.
people can
Let's
hear
see.
us, oh, chat's disabled, they said.
I just changed it, so it should work now.
All right, where are you joining us from today, everybody? Put it in the comments in the chat if you can use the chat.
New
New
Jersey,
Jersey, Illinois, Boston, Raleigh, LA. Awesome. Awesome. Good
Virginia,
good grouping of people.
And we got
Atlanta.
Chicago and Indy. All right.
Bay Area, community property state problems. Yay.
hmm
Seattle, same thing. It's a good group. So
Yeah, Sacramento, that's early. Y'all are early, guys.
So,
Good for you.
Megan, Connor, we're talking today about ways people can save money on taxes next year and not necessarily
hmm
pay too much to the government, right? So that's kind of today's
hmm
webinar. We're going to make it conversational. And essentially, we're just going to kind of like wander like a meandering river wherever our people in the chat want to go. So we do have like a list of things to talk about, but we kind of just want y'all to just sort of talk about what you want to hear about. So we make this like relevant to the people who decided to show up live for this. So if you have any tax topics that you're interested in, just put it in the chat and we're going to be talking to stuff just more generally as well. So maybe the first thing we could maybe talk about is Roth problems. We have a
Oh
whole, I think,
gosh, yeah.
podcast coming out
Oof.
with that. But Roth problems are something that we've seen a lot of. Things like people failing to do the 8606 form, like that just declare a Roth conversion as taxable income. I mean,
hmm
hmm
recharacterizations. So maybe if you guys could start off just sharing a little bit of the stuff we've seen this season about just major Roth problems for student loan borrowers.
hmm Well, I think first and foremost, I think the biggest problem is a lot of times when folks don't realize they can't be contributing to a Roth directly. So if you're for your student loan plan, if you're planning on filing taxes separately, let's say for 2023, let's just talk about this most recent year. 2023 is moving along, you're contributing to your Roth, but later on in the year or come tax time, like this year, you decide, oh, I need to file separate for student loan purposes. Well, you already did direct contributions to your Roth IRA from last year. So now we have to go fix it because if we file separately, you can't make more than 10,000 a year, which you are probably making more than 10,000 a year if you have student loan debt. So we have to go and recharacterize those contributions from Roth contributions to IRA contributions, basically fix it in that way and then convert it. So that's what the backdoor Roth is when we contribute to an IRA and we convert it into a Roth. That makes it kosher to be able to contribute to a Roth, but technically we're not converting or we're not contributing, we're converting into, if that makes sense. So that's number one is like knowing whether or not you should be contributing directly. That's, filing separately, we cannot contribute directly. Also, if we make above certain income thresholds, so if we make more than I think it's like, let's round to like 140,000 and you're single, you're not going to be able to contribute directly to a Roth IRA. So you have to do that backdoor Roth. Now, that gets complicated on tax forms, right? And I think you saw a fair share of those tax forms, Connor, this year.
Oh
You
my
want to
gosh,
share about
yeah.
that?
Yeah. So if you're doing well, first I'd even tack on to what you were mentioning, Megan, about having to recharacterize or undo your contributions. Man, if it's after January 1st, it can be done, but it
hmm
is you
It's
unless
messy.
you yeah, you got to really like paperwork. And it's same with
Yeah.
the backdoor Roth contribution. So the way that you do that is you contribute to a traditional IRA, non-deductible, right? You don't write it off on your taxes, and then you immediately convert it, keyword immediately, into your Roth. Now, some folks let it sit for a little bit. Maybe it generates a little bit of interest. Let's say, like last year, the limit was 6,500. Let's say you put 6,500 in your IRA and it earned $10 before you switched it over to Roth. That's okay, right? You'll be taxed on the
hmm
$10, not the rest. Um, but if you do your conversion after the first of the year, you have your 2023 IRA contribution that was non-deductible on one tax
hmm
form for 1 year and the Roth conversion on another year.
hmm
And now you're now your preparation, your tax prepping next year is going to be so much more complicated because you have this Roth conversion. You don't remember, it was a long time ago, right? Um,
Yeah. Where like it washes out, right? Like that's
mhm.
it's not the problem. Like it's more so just like remembering that you did this, remembering that you need to look for certain forms because custodians, like your CPA, like, it's your responsibility to know about like these conversions and to make sure that they're showing up correctly on tax returns. And if you're looking between multiple tax years, there's definitely more room for error. So like, can you convert after the start of a new year? Yeah, you can. Mechanically, you can. But it does make record keeping harder. So doing it in the same year is ideal, and doing it immediately, like you said, is ideal to avoid interest accrual that can then become taxable to you. Sometimes that's unavoidable, like with where interest rates are right now and like money markets or things like that. But those are some of the definite issues we've been seeing with Roth IRAs this tax season.
And if you
Anything you
don't
want to add,
recare,
Travis?
oh, I'll
Oh yeah,
just
go ahead.
tack on. If you don't recharacterize your Roth, it's what? It's a 6% penalty, right, on your contribution for
Yeah,
every,
unfortunately.
yeah, per year. I mean, it's
Yep.
a big penalty,
Meaning like if you weren't supposed to contribute directly, then
right?
you have to pay penalties for when it's sitting in there incorrectly, 6%, which is a pretty steep penalty. And then we do have a whole other webinar that we did on Roth IRAs where we talked about pro rata. That's a whole other can of worms if we're talking about backdoor Roth. So we'll save that for you to go check out on one of our last webinars that we've done in the past. It's on YouTube right now.
So one person, one person said they want to hear about like ways business owners can lower taxes. Folks, we want to
Mm.
have you put what you're interested in for taxes on in the chat today, so we can kind of customize this webinar to you. So we can certainly talk a lot about business taxes and lowering business taxes, but again, we want to hear what you are interested in terms of lowering your taxes, things that you are curious about, things that stress you out, just any part of the tax process that you want to ask about. We'd love to see what people's comments are on that. So for business owners and taxes, so Roth is definitely stressful, but it's also something that is a few $1,000s that you can do, right? Like it's not like this. I mean, you can do mega backdoor Roth and you can do some fancy planning stuff with that, right? But like, it's not something where you're going to use it and save 10 grand in tax, right? Like at
Okay.
least up front, right? So could y'all talk about a little bit, maybe about like what's an S corp? Maybe talk about like what is QBI? What's going to, specified trade and service business, things that could impact our clients, especially, and be able to claim those deductions. Just to like at a very high level, like what are the kind of like the common ways that business owners can save a lot of money in taxes.
Hmm. I'll mention one thing, and I know Connor, you've got a lot to say on this topic too, but one thing to maybe just start fresh with is make sure that your P&Ls, like your profit and loss statements, are looking good. Like they're clean, you you did your bookkeeping, or and this for businesses, absolutely, you probably need to be using like QuickBooks or some kind of software to track your income and expenses. Definitely do that because it is very complicated to go back and look the past year to try to figure out if something was a business expense or not, or what category it was in. It could just make tax time really stressful. So keep good books. This goes for if you also have like a side job or like a little fun project that you're doing as a sole proprietor. Track the income, track the expenses. You don't have to have like, QuickBooks software or something like that if you're doing something smaller, but you still need to track those expenses. Um, and make sure you're categorizing like what type of expense was that. That just makes your tax experience when you're starting to pull these things together for tax time so much easier. Keep your business and your personal separate as much as you possibly can. So have separate bank accounts for your business expenses and your income. Have separate credit cards for like if you're spending for your business. Like personal and business need to be separated. So that's like a housekeeping thing at the top. Now, other things for saving money. I'll let you chip in there, Connor, if you want to jump in off of to
Yeah,
piggyback off of that.
I'm always thinking investments. So my mind immediately goes to the 401k, right? A solo
Hmm.
401k. If you're a sole proprietor, or I guess just like a single business owner, you can contribute to a solo 401k and you have a really big contribution limit. And that amount that you put in there can be fully deductible, right? Lowers your AGI, doesn't show up for your student loan payments. So I would suggest using a solo if you can. Now, if you're in a business that has employees, you can still start a 401k plan. If you don't have one already, it sounds kind of scary, right? Everything has always been 401k plans are really expensive and they're a pain to run and administer. That's not necessarily the case anymore. There's tax credits that you can look up from the Secure Act that pay for almost all, if not all, of the cost of having a 401k plan. So, you do have to make small contributions to your employees' accounts. Part of that can also be subsidized by the tax credits, but that can allow you to put away a ton and really lower your tax bill. So for 2024, I think it's 23,000 that you can put in your 401k as an employee, and you get to make the employer contribution, right? So let's say you're single member S corp, you can contribute up to 25% of your W-2 pay as the employer. That's on top of 100% of your W-2 up to the 23 limit. So there's a huge amount of room there.
Yep. Yeah, and identifying what kind of repayment or what kind of like retirement account could be helpful. Like I think simple IRAs were really popular for a long time because 401ks were too complicated for a while, but there's been lots of change there. There's been lots of things that have come out recently that's made opening a 401k for you solo, like as a solo 401k, or you with your practice or business, a lot easier and a lot cheaper. So that's something to look into. And there's also what's called a safe harbor 401k, which helps prevent some of the issues that might have been historically with 401ks on contributions between like your employees and you. There were like limitations on how much like the business owner could contribute or have in their accounts compared to what their employees were contributing. And sometimes that created like some complexity there to where it was like, well, I don't know if I can even contribute this year because my employees aren't contributing or whatever it is. There's what's called a safe harbor 401k, where there's some rules where like you have to contribute something to your employees' accounts, but it helps avoid some of those like limitations or complexities that might make you like, not be able to contribute as much as were like the limits. So that's nice that there's options like that. I think knowing what business expenses you can deduct is important. Right. I think Travis, you were saying
I,
something about like home renovations or something that cannot be
Well,
deductible.
there's like legit deductions and then there's like
Yeah.
fantasy
Sketchy
deductions, right?
deductions. Yeah.
So I mean like so like I'll give you an example, right? Like we just went through our first, tax season. It was pretty stressful at times. And like one of the things that was tough is we had some business owners that would submit P&Ls and like some people legitimately didn't understand that like you can't deduct everything, right?
hmm
And so one example of this was like someone submitted, you know, student loans, like their
hmm
living expenses, right? Like they deducted their car, like they deducted, and some of those things you can deduct. You can do 179A like bonus depreciation on a vehicle over 6,000 pounds, right? If it's in the name of the business, right? You can do stuff legally, but the deal is you've got to make sure you're doing it legally versus illegally, right? Just because you want it to be a deduction doesn't mean that it is, right?
hmm
Meals, I think there's 50% meals deduction, right? I mean, there's certain things that like you have to like keep receipts, right? So a lot of this stuff is like um, there's just all kinds of complexity with the tax code. There's a lot of questions though that we got. I just wanted to cover these.
Yeah, I saw
And
some good ones.
if y'all don't mind, if you want to make those visible to everyone, I'm sure other people have the same similar questions. A lot of the visibility is just limited to hosts and panelists, but it's just whatever y'all want to do. If you want to be anonymous, ask it to hosts and panelists. If you don't mind other people seeing the question, you can make it visible to everyone. Um, so a lot of people would just want to know, like, how do you decide between like maxing retirement and doing money into a mortgage? And there's a lot of like misunderstanding on like what tips the scale between that conversation. So I mean, I guess like could we talk about there's really two different people in the world, and I don't want to trigger anybody, but there's people with like a pre 2022 mortgage and people with a post 2022 mortgage, and like why that might make a difference in the answer for that question.
Yeah. So pre 2022, which I was in that boat, mortgage interest rates were really low. And people who had mortgages before 2022 were able to refinance and get rates in the 2s and 3% percent ranges, right? I think Connor, you're in that bucket too, right? 2022, something
was
like that.
past tense.
Was. Oh, yeah, you were, then you
Yep.
moved. Yep.
The good old days.
Yeah. So before then, like that is a cheap mortgage, 2% or 3% on a mortgage. That is cheap money. And when it comes to comparing that to what you could be doing with extra money. So let's say you have your mortgage payment, it's 3,000 a month, you've got an extra 1,000 a month to do with. Should you put that towards the mortgage or should you put it towards something else like investing? And we do play the interest rate game here, right? Because if our mortgage is only charging 2 or 3%, what could that money be doing for you elsewhere? Like if we were investing it long term, maybe we're able to get 5 to 10% long term if we were, investing and having it earn money for us over time. That's changed for folks who have bought post 2022. Interest rates have definitely doubled. We're seeing 6, 7% for mortgages at this point. So that has, I think I saw the term like tip the scale a little bit, right? Because now we're in kind of that gray area where if we invested that extra 1,000, maybe it makes 6, 7% long term over time, but not every year. And so that's when we have to decide, is our retirement on track? That's maybe the next question we want to ask. Like, are we on track with retirement with how much we're saving? If not, maybe we still prioritize saving and investing with that 1,000 extra that we have. If retirement's looking great, we have extra money we want to do something productive with. Maybe the mortgage makes sense to pay down because of how high the interest rate is. And mortgage interest is deductible. So it might make your effective interest rate a little bit less if you factor that in, but still with like a 7% rate and deducting that interest, like it still makes your marginal like interest rate probably pretty high, like probably still like 5, 6%. So you have to look at the bigger picture too, is like what area in our plan needs some attention. And then you could start to apply that to comparing the interest rate, if that makes sense. But anything y'all would add to that?
I
I think
completely
people.
agree.
Oh, go ahead, Connor.
Yeah, I like to lean on the qualitative part here too, right? That um I always encourage. I think this was a question from a good friend of mine, Ben. And I you know I think we can't forget like how nice it is to not have a big mortgage payment, right? Like any money that you save is, like Megan said, it's essentially like earning 6 or 7%, right? The more that you put down on that house, it's earning 6 or 7% in the form of interest that's not being charged to you. So that's a pretty good ROI, right? And on top of that, you get the nice quality of life of new home and, lower mortgage payment that you don't have to worry as much each month. Yeah, so I lean on that. But that being said, also, we can't ignore that any money that you put in that 401k, um, let's assume that you are student loan free by the time you retire. I sure hope if you're on this webinar that you're student loan free by the time you retire, um,
Mm-hmm.
that you just save 10%, right, on that money. Like you put $1,000 into your 401k, that would have been money charging you 10% on your IDR plan. So, we can't ignore that ROI too. Um,
So,
Yeah.
so I want to call out a couple like specific questions too in the chat, just to make sure y'all feel like you're getting your questions answered here. Somebody asked about muni bonds, and I think this ties into the mortgage question a little bit because it depends on what the after-tax interest rate is, right? So I'm gonna do a little mathy stuff real quick. Oh, can you turn on screen sharing, Megan?
Oh, yes, I will. Here
It's
you
always risky when I do when we turn on screen sharing.
go. I put
Um,
rails on Travis sometimes.
we
oh, you
we
got
we got
to.
we got Travis started on bonds. Let's go.
There you go. So you see those interest rate, right? This is the Vanguard money market fund right now, yielding about 5.27%, right? And so you might think, oh, that's amazing. I want to dump all of my money in that, right? And that could be a fine decision. But there's an alternative, and the alternative is the tax-free money market fund that is not counted into your AGI, right? This is yielding 3.8. So you might say, and by the way, money market funds, they keep a stable dollar per share. It doesn't go up and down. Basically, it stays flat, right? So it's essentially, you could think of it as like a savings account. So you might say, well, why would I ever put my money in, 3.58 instead of 5.2, right? So those are some of the things when you think about taxes, what you got to think about is not what you get pre-tax. You got to think about, what am I taking home? Because that's really what matters, right? So if you look at an example of somebody who's looking at a 5.27 interest rate, you got to pay tax, right? So it depends on what your marginal tax rate is. But let's say you're in a 37% marginal tax rate. That would be somebody that's in a very high income tax rate, to be honest, right? But let's say you're in that top tax rate. Now you have to pay something called net investment income tax if you make over 250K a year. So that's about 3.8% on top of 37. And then IDR, if you have a graduate degree, income driven repayment, that's an additional 10%. So what this math works out to is instead of you earning 5.27 after taxes, you're only earning 2.5, right? And like when you're comparing putting money into your savings compared to paying down your mortgage, let's say your mortgage is 3.5, right? So if your mortgage is at 3.5, are you deducting it or not? Right? And if you're not able to itemize because you don't have enough itemized deductions, then you're not deducting your mortgage. It's after tax interest if you're not deducting it, right? So in other words, a 3.5% mortgage, if you're in a high income situation, that actually might be bad debt. You actually might rather pay that down if you're in a very high income tax situation. Now, this math is different if your marginal tax rate is different. So for example, if you're like a 24% type of bracket, now 5.27 is more like 3.28 instead of 2.5, right? So it's not quite as bad, but the tax-free interest on the muni money market funds is superior to the after-tax interest in this scenario. Now, what happens if you get PSLF, right? Let's zero out PSLF. Well, now the after-tax interest on the taxable money market fund is better. If we zero out the net investment income tax, because you're not getting hit by that, now you're at 4% instead of 3.5. So just by understanding, so everybody, hates AUM fees, right? I don't want to pay an AUM fee, right? A lot of people say that on marketing and online and social media and stuff. People pay 1% AUM fees all the time, a lot more than that, actually. It's just because they don't understand the tax code, right? And this is like on interest and savings. So I can't tell you how often that we see people in student loan consultations that have 100 grand in cash, and it's either sitting at a low yielding taxable account or it's sitting in what they think is a high yield taxable account, but it's taxable and they're IDR plus state plus federal plus net investment income ACA tax is putting them in a threshold where they're not earning 5, they're earning 2, right? And so a whole lot of this is like, how do I keep more of what I earn, right? Like, how do you keep more of what you earn? Like, that's really what matters. And so maybe we could do some just rapid fire questions if that's cool.
Mm-hmm. Yeah, I saw
Um,
a couple of that were rapid fire.
yeah, and so let's see if
Um,
which one do you want to cover?
well, I figured so there's one just to reiterate, like you cannot pay student loans or you can't claim student loans as a business expense. There is
Hmm.
such thing as it's 5,250, so 5,250 that you could have as an employer benefit. It has to be a benefit to you and your employees that is tax free if you were to pay an employee's student loans. There's some complexities to that, but you cannot simply just write off your student loan payments if you're a business owner. One of the other quick hitter ones I saw was, would you be able to offset the impact of your or like your adjusted gross income with your mortgage interest? So mortgage interest is a below the line deduction. It's not going to reduce your adjusted gross income.
What
So
does
if
that
you
what does that mean? What is below the line? What is
yeah,
above the line and below the line?
yeah, above the line. So how you can affect your student loan payment, because student loan payments are based off of AGI, adjusted gross income. So really all that's subtracted from your gross income to get to adjusted gross income is pre-tax deductions like 401k, IRA, if you are eligible to deduct that, HSA contributions. Those are like the main things that you can control to reduce your AGI. Everything else is below that. So, like deducting mortgage interest, that would be an itemized deduction. Otherwise, you take the standard deduction. So, anything below that line that's not like a retirement or health savings account contribution is below the line, and it's not going to affect your adjusted gross income for student loan purposes. So, it still makes a difference in your tax situation. So, of course, those are still like important things to figure out if you need to be taking those deductions or not. Um, but it
But
wouldn't affect your adjusted gross income.
could I like ask something there though? Like so,
Hmm.
but there's like another way which is like the additional income sections, right? So like if that's I totally agree like on that W-2 side of things, but like if you have
Hmm.
additional income, that is a big way to lower AGI too, because it just doesn't add up to the same number, right? Like the tax-free interest, the Schedule C income, the K1 income, which is the flow through from the S corp, right? So like, could we also talk about just like, how it kind of makes sense to, as long as you're not just like literally being poor, like as long as you can like kind of lower that like additional income number legally, like how that
Mm-hmm.
impacts AGI, like because that's like I think that's like something that I didn't think about until we got through tax season.
Mm-hmm. Now, do you mean like with sole proprietor income or K1 income, or is that what you mean?
Well,
Like,
so there's like two ways to lower your AGI, right? There's like deductions, and then there's like lowering sources of additional income.
oh,
Now,
yeah.
you
Mm-hmm.
wouldn't just want to lower sources of additional income just to lower them. That's kind of dumb, right? But like,
Yeah.
but but if you have like, some legitimate business expenses you've overlooked, or you have like
Mm-hmm.
Schedule C that like you didn't keep track of your expenses, or you've got like an S corp that you can write off like, write off certain parts of it, right? Like, you can set up, you know I don't know, just you can
Mm-hmm.
do a lot of stuff like QBI, right? That like lowers what that K1 take home pay is. Um,
Mm-hmm.
so yeah, I mean, like, does that question make sense at all? Because I think a lot
Mm-hmm.
of times we focus only on the 401ks, the HSAs, the student loan interest, that kind of stuff that lowers that AGI. But sometimes I feel like we don't think about the fact that like people are putting $100,000 in a taxable savings account and adding an extra 5,000 a year of income that's increasing their AGI, if that makes any
Mm-hmm.
sense.
Mm-hmm. Yeah.
Instead
Do you
of
want to
putting
jump
it in
into
the
that one,
tax
Connor?
free, instead of putting it in the tax free interest bucket. But yeah, Connor,
Mm-hmm.
Yeah.
I'm
Well,
just trying to be combative for fun here, guys. I apologize. I'm just trying to, just try to give the people what they want.
yeah, I think I completely agree. You do want to be very conscientious of what you're deducting for your business. I'll just talk about that one. So I work with a lot of practice owners, and how you decide when to buy equipment and how you depreciate it is very important. You can make an election called 179 that Travis mentioned on vehicles, but you can also do that on anything that you would depreciate, right? Any big equipment purchase for your business, you can choose, hey, maybe I write this off over time, right? Let's say it's 10,000 and it has a useful life of 20 years. Maybe I take $500 a year against my income because my income's not very high right now. Or my income is really high right now, and I want to write the whole thing off this year. You can do that, depending on what kind of equipment it is. So you could take the whole 10,000 in 1 year. And I think that's really important, right? If you're near the end of forgiveness, or if your income is really high, um, that would be a situation in which you'd want to take those deductions, right? You'd want to maximize as much as you could write off against that income.
Mm-hmm.
What,
That
yeah,
makes
what do you think,
sense.
Megan?
Yeah, well, and I think to piggyback off of what you were saying earlier about like where your money's sitting, like your money sitting in a taxable account is going to generate income for you that maybe you weren't factoring in. So like dividends or interest that you're earning on certain vehicles that your money is in, that's something to be cognizant of. And making that more tax advantageous or tax efficient. That's something that should be a focus as well if you're trying to keep your income as low as possible. Now, I do kind of like you said, Travis, like it's not a good idea to try to make less income. Like that's not what we're saying, right? And I have people ask that all the time. It's like, well, how much should I keep my income at to keep my IDR payment lower? Um, I wouldn't say that that's necessarily the right question to ask. I think it should be more so like, is your income structured in the best way possible, the most tax efficient way possible? And if you are making a lot more income and that does make your income driven payment higher, that's not necessarily a bad thing. Like more income coming into your household is a great thing. We could do a lot of productive things with that. So I wouldn't want you to feel like, leave this conversation thinking like, I gotta somehow reduce my income. That's not what we're saying. It's more so
I,
just making sure it's efficient.
I like to ask people the Swedish question, which is I like to be like, let's pretend that you're a Swedish citizen and your tax rate's 75%, and you have a choice between getting $100,000 of income or not getting $100,000 of income, and you get to keep 25 of it. Would you like that income or not like that income? And most people are
Yeah.
like, is like they're waiting for like the trick question. You know what I mean? Like sometimes I'm just insufferable, right? With as you guys know. And then people are like, I guess I take the income. And I'm like, yeah, it's $25,000 more than you had, right? And like if you had to sacrifice like a ton to get that income, maybe it's not worth it because you're losing three-quarters of
Mhm.
it, to taxes. And so maybe if that requires you working a fifth day a week and that is exhausting to you, maybe it's not worth it, right? So I think
Yeah.
like a lot of times like what we talk about is just like what is your ideal life? Like that's where it starts from. Like the whole point, like the point of taxes is not to pay as little in tax as possible because maybe you hate the cold. Maybe you don't want to live in South Dakota when it's negative 20 degrees because you'd rather live in California on the Pacific coast where it like never gets below 40 or 50 or something, you know, and there's zero humidity, right? So like I think sometimes like people think about like, oh my gosh, I got to minimize my taxes. Well, shoot, like there's more to life than like how much taxes you pay, right? Like you want to kind of pay as little in tax as possible given the life you want to live is kind of the
Mm-hmm.
way like the thing that I push people to do because I mean you can definitely lower your taxes, right? You can buy a bunch of Airbnbs and work yourself to death and you can have your spouse become a professional real estate investor status and you can donate all your money to charity, right? Like there's great ways to pay zero in tax, but like what's that ideal life? I mean, I think that's the real question that you have to ask
Mm-hmm.
first before you start thinking about what kind of deductions can I do, right?
Yeah.
Can I
I
tack
th-
onto this question too? Because we had somebody
Sure.
ask in the chat about living in a duplex. Like, how does that affect
mhm.
my taxes? Which is kind of relevant to what we're talking about, right? So I actually did the same thing in Chicago. Sold the building last year, and my biggest recommendation would be make sure you depreciate it, just like any rental property, right? Even if you live in half the building and the other half is rented, depreciate the half that's rented, um, and take as many expenses against that income as you can, right? The best rental is the rental that on your taxes is the big donut.
Yeah.
Can I say too one thing that kind of shocked me about this tax season, which I should have known, but I didn't until we like got through our first tax season, is like the difference between AGI and taxable income. It's kind of like a basic difference, but I think that like people don't think about it like that, right? Like when the person is asking about this mortgage interest deduction, like they're probably interested in like, could that lower my student loan payment, right? And like if it's so there's like two different calculations in your 1040, right? There's like line 11, which is like adjusted gross income, and that's like the deductions like the 401k, right? The HSA, the student loan interest deduction, that kind of stuff that gets you to that AGI number. And then like what is your taxable income is lower than that, right? And you either take the standard deduction, which is about $14,000 for an individual, or you take itemized deductions, which is however many deductions that you have allowable, things like charity, mortgage, healthcare expenses, state and local taxes paid, real estate taxes paid, et cetera, right? So this person's got 40K of interest. If the mortgage is below 750K, then he can deduct all of it, right? So, that taxable income could be lower by $42,000 of interest instead of the standard deduction, which is about 14. And so his taxable income might be 42K lower, but the AGI is not 42K lower, which is what they take the student loan payment off of, right? So the AGI is like lower from the above the line deductions and then from lowering your sources of additional income, which is typically where you want to really focus your efforts on like the business write-offs. So it's kind of like, W-2 people, you can take it down to the above the line deductions and then you have to stop unless you want to do more advanced things that might not be worth it, right? So can we talk about maybe some tax fantasies that we've seen from people? So specifically like real estate is like the sort of the siren of the tax world, right? Like everybody wants you to get involved in real estate and write off all of your W-2 income to zero. And could we talk about some just like reality check about what that actually means for lifestyle? Like if somebody does want to get involved in real estate and Airbnbs heavily, like what does
Mm-hmm.
that actually mean in terms of like their quality of life to get down to very little in taxable income?
Yeah, I'll say a couple quick things, and then Connor, I'm sure you have more to say. But I think a lot of people assume that having real estate is very passive, and it's just not. Um, it's very rare where it's very passive. And passive, like the way I think about passive is like money in a brokerage account paying you dividends every year. Like that is super passive. I just had to put my money in that account and have it invested, and it pays me dividends. That is passive to me. Real estate is not passive in that sense. Like you're either hiring a management company, right, to manage like people coming in, coming out, the cleaning, the maintenance, or you're doing that yourself. So you're paying somebody to do the management. That's kind of like, when you think about it, that's like an AUM fee right there for real estate. You're paying someone to manage the real estate. So that is an AUM fee if you want to think about it that way. If you're doing it yourself, you're having to figure out like, okay, well, I hope I have renters. That's the other thing is like you hope you have renters, you hope you are able to, make what you are paying on that each month to make it worth it, but also taking into account like the problems that happen, like maintenance or bad tenants or, oh my gosh, my like, I don't know why this is a irrational fear of mine because I don't have rental property right now, but squatters. Like, have you like seen those like news articles about squatters and squatters' rights? Like that scares me to death. And I don't even have rental property right now. So like it's not as passive as people think. That's what I was gonna say. But I'm sure you have some other smart things to say, Connor.
Yeah, I thought it would be more passive than it was. It was fairly passive until the pipe burst in the middle of December. And now
Hmm.
we're like calling a plumber and there's water running off the side of the building and it's like, "Oh my gosh, what are we doing?" Um
Hmm.
yeah, I mean having a rental property is properly a business, right? Like you need to
Yeah,
be keeping receipts,
it's
you need to be
work.
tracking your expenses. Yeah, it's a lot of work. And to be honest, you know, I think if we look at the numbers, if you think about yourself, a lot of our clients are paid hourly or think about their hourly time and what the value of that is. And lots of times it's quite high, right?
Hmm.
In the hundred plus several $100s an hour, maybe. And if you think about the time that you spend on a rental, if you're self-managing compared to, like you were saying, Megan, if you just set up a brokerage account and you do tax loss harvesting, that's like that is the passive version of real estate,
Hmm.
right? Where your net worth is growing, but you get tax benefits. It probably works out on your hourly time. It works out better to do the brokerage account, I'd bet. Uh,
Yeah. So I think the point of that too is just like you really have to want to do it. Like you have to really enjoy real estate. And so people who want to get into it because maybe their friend did well with it or it, everybody says, everyone should have real estate. Like, I think you need to just think about your goals and what you want for your life, what you want to deal with, what is going to make the most sense for your family. Your financial plan is completely separate from anybody else's. It's completely your plan. And to me, I'll admit, like, it does not sound attractive to me to own property and to have to worry about it or manage it. I'd rather dump my time into something else, fun, or into something that, in my mind might be a better ROI. So I'm probably, everybody has their opinion on it, but I think you just have to make sure that you want to get into it for your own reasons and you're okay with, what's all to come with it, I should say.
Can I push back a little bit though? But
Sure.
I saw this ad on Facebook that said that doctors like me need to buy this $50,000 course. It's going to teach me how to pay zero taxes, and all I have to do is join this $50,000 course, and it's going to allow me to like make my W-2 zero. So like that's what I heard. Why shouldn't I do that? Like, are you trying to take away my dreams?
No, definitely not. Not trying to take away your dreams, just when
I think
something
I
sounds
think
too
the
good to be
reality is
true, like
there's 100% ways to do the real estate stuff and write off your W-2 income to
oh
zero if you
yeah.
wanted to. It's absolutely true, right? But you have to have like in a short-term rental situation, you've got to have material participation, which means no property manager allowed. You've got to do all of it yourself.
Hmm.
And by the way, like this, Tax Cuts and Jobs Act bonus depreciation, it gets phased out to zero in the next couple years. So like all these people that are buying up all these Airbnbs and like writing off all the bonus depreciation, like the bonus depreciation drops to zero, and now you're just straight lining the depreciation probably, and the depreciation on a short-term rental is way higher than what the IRS is going to give you at the straight line. You know what I mean? Like you're talking about replacing a lot more stuff than just the normal wear and tear of a long-term rental, right? I mean,
Hmm.
so I think that's kind of my fear for a lot of the people that got heavily involved in the Airbnb thing is everybody was getting involved in it because of the write-offs that you could get in 2020 and 2021, and you also had peak demand for people because of COVID in 2020 and 2021. So the business looked amazing, looked gangbusters, like the best ever. And now you've got an oversupply because of tax policy, and you've got an under demand because of people like having normal lives again, right? So I think that, what the lesson for that is when you're looking for ways to lower your taxes, don't make the taxes the priority. Make the goals
Hmm.
and the investing the priority, right? Like it's got to make sense from an
Yeah.
investment perspective for you to jump in and do something for tax reasons, right? Like there was a paper one of my buddies wrote one time about like oil and gas, like uh, trusts or something like that. There's some sort of investment you can make and you put your money in and it generates losses that you can use to offset income. There was just one problem. All of the returns for these things were like negative 50%. So it's like, like people ended up losing most of all of their money, and sure they generated losses, but like, you literally would have done better just taking $20 bills out of your wallet and just throwing it in the fireplace because like it was just destroying money. Like, of course you can generate losses that offset your income when you lose all of your money. Like, yeah, no, give it to me. Sure, let's generate some losses, right? I mean, like, So you gotta have not you don't want to have like the tax minimization, tail wagging the dog. I think that's just a
Hmm.
big mistake. And yes,
Yeah.
people want us to clarify our acronyms too, right? Um, so I mean, so I guess like in a if we were gonna look at some of these business owner questions too, what you don't know can hurt you. So somebody's talking about their workplace is offering them a simple IRA, about to offer them a simple IRA. So, I mean,
Hmm.
if we could just cover some of these really fast,
Hmm.
the government wants to set up a 401k for your company and pay for it for the next few years, right? So the Secure 2.0 Act, instead of doing that simple IRA, you could tell your practice owner, hey, if we don't have a 401k, the government wants to pay most all of the setup fees and they want to pay up to $1,000 to cover the match for every employee. And that's cheaper. It's cheaper to have a 401k than a simple IRA now under current law, right?
Hmm.
So
Yeah.
Mhm.
that's pretty legit. And then let's
401ks
see.
have
Okay.
bigger buckets too. That's like the knock against simples. Simple
Yeah.
IRAs, you have a limit of 5 or 15,500 per year that you can contribute, which a 401k, you have 23,000 as an employee, even more as an employer. So there's just a bigger bucket with the 401k, and you have the option to do a Roth 401k if you wanted
You,
it.
you know what makes me mad about simple IRAs? It's not simple. That's so
It's really
insulting.
not.
Like to call
It
it a simple
isn't.
IRA is kind of like I don't know, like it's like an insult because like
Yeah.
simple IRAs are like the exact opposite of simple. Like it's freaking confusing.
There's so
Like
many rules.
it
Like,
confuses me sometimes and like we do this
yeah.
for a living, right? Like it's just
Yeah.
like it's kind of like I don't know, like don't ever pay for help with your student loans. You never ever need to pay for student loan help with student loans. It's like, okay, Department of Ed, are you gonna hop on the phone with me to Mohila and explain to them why my like PSL payment counts off by 5 years? Like, like I mean, sure,
Yeah.
yeah, technically that's true. You shouldn't have to pay for help with student loans. Well, you shouldn't have to pay for help filing your taxes, but oh wait, the tax code's like 1,000 pages long, right? And like benefits high income earners more than lower income earners, right? So it's like all these I mean, I don't know. It's just a big old mess, right? I mean, the
Yeah.
taxes and everything. I mean,
Mhm.
so one more Travis rant, if I could. Contributions. So many people make horrible mistakes with their
Uh-huh.
withholding.
Yeah.
So could we talk about W-4 withholding and could we talk about retirement plan withholding, especially when people switch jobs? So could we explain
Yeah.
why a W-4 is important and then why is like retirement withholding important?
Yeah. So if you're a W-2 employee, usually when you get started with a job or annually, your HR might send it to you annually, you get this W-4 form, which is supposed to help the payroll company estimate how much taxes they should be taking from your paycheck to, estimate your total tax liability for the year and make sure you don't owe or get a huge refund at the end of the year, right? So it's important to keep that up to date. A lot of our strategy with student loans is considering filing taxes separately. On the W-4 form, there is an option to disclose that you do file separately. You could also disclose that you have a second job because if you have one job that pays you like 30,000 a year and you have your withholding set up for just that $30,000 a year like W-2 job, it doesn't know about any other job that you have. So it's estimating taxes as if you're just going to make 30,000 that year and not coordinating with any other income sources that you have, right? So you might be way under withholding. So that might be a reason for why you have a big tax bill at the end of the year. So withholdings are important, and a lot of times tax professionals or tax software will give you estimated quarterly vouchers where if you owed taxes, it'll generate an estimate for how much you should pay on a quarterly basis to one, just keep you, in or keep you updated with how much you should be paying for the year in tax, but also to avoid penalties like for not paying tax on time. There's a small penalty for not paying your estimated taxes on a quarterly basis. Really small, but still it's avoidable. And then there's also a penalty for, if we've under withheld at the end of the year, we didn't pay as much tax as we needed to, the IRS will penalize you for that as well. So your W-4 is important, but also those quarterly estimated payments are important too. But you want to add anything to that, Connor?
I think you covered the W-4. I wanted to talk about retirement contributions.
Oh yeah, yeah, you
Because
jump into that.
if you start a new role, odds are they probably, well, if your employer auto enrolls you at all, you're probably started at 3%, right? Which may be quite a bit different than your prior role. So you want to be careful about that. Make sure you check it. Let's say,
401k, right?
yeah, right, a
401k. Yeah.
401k, right. Um, let's say if you wanted to max out your 401k, but you weren't quite sure like how much gets you there. Um, Contribution limit is 23,000 for 2024. What I would suggest is do the rough math and then up it by a percent. So let's say you make 100,000 a year, right? 23,000 would be 23%. That would max out your 401k. I would bump it to 24. The reason that I say that is December, the end of the year, is typically the most expensive year for most households, right? You have a lot of expenses going on. I'm sure Travis can relate to this with the kids, and you got presents and end of the year. That's a lot. So if you increase your 401k contributions just a little bit more than what they should be, you will hit your max and your employer will automatically stop your contributions. Maybe it's late November, maybe it's early December, and then you get a bonus, right? It's a bonus from you to you on your last paychecks in December. Can help
Yeah,
with
for not
that.
having that withdrawal. That's a great
Hmm.
strategy for if you're at the same employer for the whole year. But a cautionary tale here is if you're at different employers throughout the year. Let's say you started one job, you worked there for 4 months, you contributed to their 401k, you moved to a different job, started contributing to their 401k. um, the two companies are not going to coordinate together. They're not going to communicate about how much you contributed to your 401k at the old job and how much you're contributing at the new job. So there's a strong chance that if you're trying to max out your contributions and you kind of forgot how much you contributed at the last job, there's a strong chance that you're going to over contribute. And if you don't catch it before you file your taxes or like in the new year, there is a penalty for that. You have to take out the over contribution and you have to pay a 10% penalty for making the contribution when you shouldn't have and taking the money out. And oh, by the way, it's taxable because on your paycheck and, for the tax return that maybe was done wrong, you got the tax deduction. So over contributions are something to pay attention to because even if it's a different employer, you could still only contribute 23,000 total as the employee to a 401k plan. Doesn't matter if it's a different company, different industry. That is the limit. The employer can contribute more. They don't have to coordinate, but you as the employee do.
So the reality is we tend to have like two big blasts when we do promote financial planning for a company. So we typically have one big one in January and a big one in June. So one of the benefits of scheduling and not like waiting is it will be very hard to get in with our planners in June. And so if you schedule now, you usually have a meeting like essentially 1 month after your initial meeting where we kind of like clean stuff up, right? So the first meeting is sort of like, what are you looking to get out of this? What are you trying to accomplish? What kind of financial planning needs do you have? Then we do a follow-up meeting about a month later to say, okay, let's make sure all this stuff actually gets implemented, right? Let's make sure we have an action plan to make sure it gets done. And so if you think about, April, May, then our planner is going to be super busy in June. That would be very valuable if your goal is to get attention, like personal attention. In terms of like, do you stick with the same planner throughout? The answer is yes, unless, obviously there's a turnover in every company. So if we ever lose a planner, of course, we would have you work with someone else. If a planner ever gets promoted to an executive role, that might result in them not being able to serve as many clients, right? So we're not going to tell you something misrepresentative and say you'd have the same person for 50 years. I mean, nobody does in the financial planning industry. I think the one positive difference for us compared to a lot of firms is the average age of our planners is in their mid 30s. And so that's people that will be in the industry for a long time. If you think about the average financial planning firm, you're talking to somebody in their mid 50s or 60s. That person, no offense, but they're probably going to work for 5 to 10 more years, right? You will have a new advisor and that person retires. And if you work with a big company, they're not going to understand your student loans. They're not going to understand those kind of things. So the other question people have too is like, do our planners actually make trades for you? We can if you want us to. So probably, I don't know, Connor, maybe about like 30, the third maybe of our clients, maybe 40%, something like that. Maybe 40% have us manage investments for them. And that's an option that we can do. And then maybe, a good number two don't. They just come to us for the financial planning and just the second set of eyes and the sort of neutral party in the marriage sometimes or relationship that's helping people be on the same direction and paddling the same way. I think that as somebody that comes from a what I would call a mixed marriage, meaning I am a saver and my wife is a spender. That's what I mean by a financially mixed marriage. It's challenging, right? Like, you're doing a big renovation project, and one person wants to hold back and one person wants to say, let's go. Like, like you only live once, and it's very valuable. I use SLP Wealth for my financial planning. And my advisors are Megan and Sim, and they've been so great at like helping us navigate the financial dynamics of our marriage, my wife and I, just to try to make sure that we're like accomplishing goals like that we both value and not being stressed about it so much. So I think, we probably can make this pay for itself pretty easily, to be honest. But at the same time, like that's not the true value of financial planning. The true value of financial planning is like the complexity that happens when like everything in your life explodes. Like you have a family, you have a house, you have a marriage or a long-term relationship, you have a business, you have a more stress at work, more responsibility at work, less time, less sleep. Your baby's waking you up in the middle of the night, right? Like, I think everybody is a DIYer in your 20s when you like have unlimited time and you're just like reading Reddit and like, listening to podcasts all day. I mean, and then like life punches you in the face and like you're trying to make large charitable deductions and you're trying to coordinate your taxes and you're trying to like do all these things. And then it's just like freaking screw it. Like, how much does financial planning cost? And like typically it's like 5x what we charge. Like a typical financial planning fiduciary fee is in the mid four figures. That's like a typical fee. And so we charge way less than that. I don't necessarily know if it'll ever be that price, forever that price. I don't think it will be, but it's a much cheaper price if that's something that you need. So that's why we're so passionate about it. And also we don't I don't want to say this in a disrespectful way. It's totally okay if you could care less, right? That's why we have other discounts. Wait,
We meet you where you are. I think that's
yeah.
what's important is like we're really passionate about meeting folks with where they are. Like we're not a firm that requires you to have a certain amount of assets to before we'll talk to you. We've always like all of us when we started this firm, we all of us had that same mentality about even like our own firms that we started before this. Like we felt really passionately about helping people from the beginning, like start to get their plan up in place, get going, like not having limitations on how much you had to have before you come and work with us, because we'll help you get there. That's the point of financial planning, I think.
Yeah.
But
And
thanks for hopping in and oh yeah, go ahead.
I was just gonna say, don't wear a suit to our meetings. It's okay to have the dog in the
Right.
background or the crying baby. Hey, okay.
Totally fine. Yep. But thanks for joining us today and talking about tax stuff, yucky tax stuff, and throwing sprinkling in some student loan stuff as well. And look out for future webinars. We'll send out a recording later tonight, and it'll let us know if we can help you.
Appreciate y'all.
Thanks, y'all.